Welcome back, and it's so good to have you folks here for our final panel of the day. And for investors in the capital markets, the past year and a half has been a time of extremes, right? Extreme losses at the outset of the pandemic, extreme monetary and fiscal support by the central bank and by governments around the world, extreme gains from the depths of one of the fastest and most severe bear markets in history, and extreme trading across meme stocks, cryptocurrencies, and even some popular tech stocks. And it's just been one of those wild times we're going to remember forever. Liz Ann Saunders has made a career of explaining market behavior and cycles to investors at all levels. She's the chief investment strategist at Charles Schwab and a voice of reason in an area of a lot of uncertainty. And in times of great uncertainty, I rely on her research so much. She's here to take us home on our last panel of the summit, and I couldn't think of a better person to do it. Welcome, Liz Ann.
Oh, thank you so much for having me. Looking forward to our conversation, as always, Caleb.
Thank you. And we've had a few conversations in the past year and a half, and I read all your research, and we keep coming back to some of these themes. But for folks who may be not familiar, what surprised you most about investor behavior in the past 18 months?
So some of it, I think, was just maybe a speeding up of some of the trends we had already seen pre-pandemic. And many of those are very positive in the sense that we have re-engaged younger people with investing, with the market, with trading. And there's sub-cohorts, of course. And I think the cohort that I've been calling the newly minted, maybe not so newly minted anymore, rapid fire day traders, that may be different than a traditional investor, but we were finding that new accounts were skewing younger even before the pandemic. And there's probably myriad reasons for that. But also, I think at Schwab, may have had something to do with commissions going to zero in the industry. I think that was a force. And then other innovations like stock slices or fractional shares, whatever terminology you want to use. And then I think with the pandemic came everybody using their devices and not having, the boss over their shoulder to the extent they were working in a remote structure, not a lot of else to do, no sports betting. And I think that combination was just extraordinary in terms of just bringing in this new cohort. I worry about the really, really speculative end of the spectrum, but ideally we transition those folks into becoming successful long-term investors, which would be great.
Yeah, we hope for that as well, but you're always going to have that speculation. You're always going to have that mania, whether it's tulips, railroads, cryptocurrencies, cannabis stocks, internet stocks.
Yep.
Right. We always have that. And you and I have talked about that, but we do hope that people use it as an opportunity to really start their investing careers and build wealth over the long term, because that's the name of the game. And that's what you counsel and your colleagues at Charles Schwab counsel so often and so well. You wrote recently that the market has gone through 3 phases in the past year and a half. What phase are we in right now, and where are we headed?
So I actually think we may be in a 4th phase that is yet to be clear in terms of the inner workings from a leadership perspective. But the first phase, leaving aside the bear market phase, that was obvious, driven by the pandemic, very short-lived. I think its short-lived nature was a function of the double-barreled stimulus from the monetary and the fiscal authority. So phase 1 from the low of March of 2020 really, I think, lasted until early September. And that was a highly concentrated phase where it was really just a very small handful of names, the big 5 in the case of the S&P 500, that were driving nearly all of the performance. And then we had kind of an interim choppy phase in September and October as we digested election uncertainty. Then we got the vaccine news in early November. And that launched a phase really until February or March that was very cyclical in nature, broader in terms of leadership, the reopening theme. But then toward the end of it, it went really down the quality spectrum. That's where the speculation really kicked in non-traditional segments of the market, whether it was, meme stocks or heavily shorted stocks, non-profitable tech, SPACs, crypto. And I think that's part of the reason why a benchmark index like the S&P has remained resilient, is that most of that speculative froth existed outside a traditional benchmark average like that. Then really when we saw the spike to 175 on the 10-year yield, and we saw liquidity start to come down in terms of the growth rate and the money supply, Then we really saw a shift back to a fundamentally driven market. Quality took over in terms of a factor that defined leadership. We haven't really been in this simple growth versus value or which sectors have done well. I think underneath the surface, it's really about quality, strong earnings revisions, reasonable valuations, strong balance sheets. And now I think we're in an environment where the market is digesting all of these uncertainties. I think it was a contributor to what we saw happen yesterday, which wasn't just the Evergrande situation, but obviously monetary policy uncertainty, fiscal policy uncertainty, the debt ceiling, the growth slowdown. So I continue to think we're going to be more fundamentally driven, but I think we're now in a higher volatility plane for the market given all those uncertainties.
Great point. And I think we do have one of your charts of the sector returns for the S&P 500 because we've had all of this rotation too, right? Yep. Investors have kind of moved from that big tech, safety of big tech, unusual, right? To have tech be big safety, but these stocks are huge right now and they are the most widely held. I'm talking about Facebook, Apple, Amazon, Netflix, Google, Microsoft. They are the most widely held, biggest stocks that actually move the indexes. But we've seen rotation going throughout the stock market. But if you're a benchmark investor, if you're an index investor and you just kick back and hug the indexes, you've done pretty well amid the madness, right?
Oh, no question about it. In fact, we constantly talk about the merits of a long-term time horizon and diversification and rebalancing, all of those tried and true strategies. Even when you talk about diversification, it's really the benefit of diversification is to smooth the ride. If you go all the way back to the 1928, the history of the S&P, and you had an investor that 100% indexed to the S&P, absolutely you would have done extraordinarily well over shorter periods of time too. The point isn't that that's not a good place to have had money over whatever period of time. It's just who are you as an investor? What's your emotional risk tolerance? Can you handle what happened last February and March, what happened in the fourth quarter of 2018, obviously to a more extreme 07 to 09. And that's really where that diversification story comes into play. But if you're an index investor, but say the S&P is just one index among other index funds that might track other asset classes, I still think the rebalancing exercise is under discussed in terms of its benefits. It's not going to grab the headline. It's not sexy. It's not the big market call that we're about to enter a correction, but it forces us to do what we know we're supposed to do as investors, which is, add low, trim high, a version of buy low, sell high. And often when left to our own devices, we don't do that. We let the winners run. They become an outsized portion of the portfolio. And when the inevitable reversion to the mean happens, you're holding a much heavier bag than you otherwise would have. It's really simple, basic stuff, but it's so important to hammer home, especially when you have all these rotations, which frankly give you more opportunity to use volatility to your advantage via that process of rebalancing.
The simple things in investing are often the hardest because we have animal spirits that are talking to us all the time saying, hey, you could be chasing returns in Dogecoin. Hey, why aren't you chasing some of these new IPO stocks or these SPACs that have come out in the last 6 months to a year? Well, there's a good reason for that. Sometimes they don't really pan out as well. And the boring stuff actually works, but boring is tough for some people. But if you look around the world,
and we seem to be in a year where there's lots of sort of shiny new objects. And that get rich quick mentality among a certain segment of the cohort we already talked about. And, sadly, that it doesn't tend to end well, even if we're not at the end yet there.
Yeah, I know. And we counsel it as well, but it's hard. And I get it because we do, again, have these animal spirits or this FOMO. Well, so they're making more money over there. Or I have a friend who just paid off his mortgage because he bought this or that cryptocurrency. Very hard to fight that as a disciplined investor, but that's the discipline and it's a lifelong journey of learning that. Let's look around the world real quick because you guys at Charles Schwab do such a good job with this with Jeff and Kathy Jones on your team there. Looking at global markets right now, the U.S. has actually held up very, very well, given a lot of the uncertainty, but there's a reason for that. Why do you think the U.S., the S&P 500 and the broader indexes here have held up better than some of the global indexes out there?
And for some of the same reasons that you've seen a lot of foreign money come into the U.S. fixed income, I think it's part of the reason why it's come into the equity side too. Plus, there is that momentum piece. There was some thinking, including by us, that as we entered this new cycle, that you would likely see a shift in leadership, maybe not dominated by non-U.S., but providing more of an opportunity to apply diversification. And we did, for part of this year, see developed international markets doing very well relative to the U.S. But what I think may have happened, and it's more subtle than I think the way people normally look at this, these significant shifts in leadership that tend to occur at the broad asset class level when you exit one dual cycle. And what I mean by dual cycle is a cycle where you've had both a recession and a bear market. They're not obviously always timed perfectly relative to one another. Usually, the market leads, and then you get the economic move thereafter. But this was clearly a dual cycle, and that tends to usher in new leadership. I think the rub in this cycle is it's really questionable whether what happened last year was truly the end of one cycle and the start of a new cycle. Yes, the NBER dated the start of the recession, they dated the end of the recession. It was only 2 months long. So, the sort of official view is that yes, you had a recession, you ended one cycle, you started a new cycle. But the unique nature of COVID, obviously, I'm not so sure that's the right way to think of it, even if that's what goes down in the history books. From a did we really see what tends to happen when you start a new cycle? And I think we're leaning toward that answer being no. Everything from leadership within the market to trends around consumer confidence, present situation versus forward expectations, the yield curve, the point at which the Fed is looking to tighten policy, the inflation story. So I think we may have just kind of took a pause in terms of what was an ongoing cycle, and that may explain why we sort of shifted back toward this U.S. leadership position.
Right. Well, we know the economy and the stock market are not the same and they're disconnected. Sometimes they do speak to one another. We've seen a lot of that lately and a lot of mixed messages across the economy. And you look at consumer sentiment, obviously very low right now because of the uncertainty out there, but it was extremely high. Just a few months ago, 6, 8 months ago, the personal savings rate, extremely high because of those government subsidies. People were banking those and putting them in the bank. We couldn't spend money because we couldn't go out. But then when we could, in the 3-month cute little period there during the summer where it felt okay to do things, we did see a lot of spending, but now this pullback. This is this push and pull that's going on with consumers right now. And I bring it up because, as you know, it drives 70% of US GDP. And if you're looking at stocks and growth, you got to look at where GDP is going. Where do you feel like we are right now, cycle-wise, in terms of the US consumer?
So let me step back kind of half a year or so and talk about that surge in consumption that we saw. Obviously, when much of the economy was shut down, even when things started to open back up, we had seen limited ability to spend anything on services related activity. So all of the spending, much of which was fueled by stimulus, was focused on the good side of the economy. And the narrative that developed when we really started to reopen and there was that pent up demand story around services, a narrative that developed, and this was really at the heart of the Roaring '20s scenario, was that we were going to continue to see strong consumption and demand on the good side. And the pent up demand on the services side would be additive to that. That was not our view. Our view was that we would see some pent down demand on the good side in favor of a pickup in demand on the services side. And that is actually what we saw. And then unfortunately, the Delta variant kicking back in caused disruption to both the demand and the supply side on services and continues to be a disruptor on the supply side of goods as well. So unfortunately, whether you're talking about big picture 18-month trend since the pandemic unfolded or some of these shorter, more micro level trends, they're almost exclusively tied to what's going on with the virus. And, we would have all hoped that 18 months later, we would not still be talking about this. But I think we're still very much at the mercy of the virus in terms of both macroeconomic trends, but also these micro trends of consumption, goods versus services.
Without doubt. And we're already, kids are back in school finally in person, but we're already seeing some schools having to shut down for a couple of
Right.
weeks. That could end up being a longer period of time depending on what happens here. So the uncertainty is still swirling around. Folks, I forgot to mention, you can be asking us questions, and we want your questions. We're going to try to get to as many as possible. On the right side of your screen there, click on that question mark, put in your questions. We're already seeing some come in, and we'll try to get to as many as possible. What are the wild cards facing investors over the next 6 months? Is it still COVID? We know we have the Fed meeting today and tomorrow. Fed policy is critical here, and when they're going to reduce their purchases of government bonds every month, and when they're going to raise interest rates, which we believe to be in 2023. But what are the wild cards we can't see right now?
So I would say a wild card that it's not that we can't see. We're sort of hopeful that it's not going to happen, but of course would be a variant, a COVID variant that is resistant to vaccines. There has been some concern about the Mu variant, but it doesn't seem to be worsening here. But that clearly would be, call it the gray swan, because it's not out of the blue. We're dealing with this, but part of the reason why I think the economy is at least been marginally be able to chug along, and school systems have made decisions, even if they have to backtrack a little about going back, is that there is still that view that the vaccines ultimately will be part of the solution, even with an aggressive variant like Delta. But I think something worse that would then cause the economy to go back into lockdown mode at a federally or state mandated level, that I clearly would be a game changer. There's very little discussion about the actual practicalities associated with what is being negotiated in Washington right now. We have no expectation that the secondary bill, the $3.5 trillion one, will look anything like it does right now, won't account for anything resembling $3.5 trillion. The tax pieces of it will be watered down. But assuming something passes, there's very little analysis being done now in terms of what that means. And I don't blame analysts for not trying to incorporate in an earnings reduction given a hike to the corporate tax rate, because we don't know the timing of it yet. We don't know the magnitude of it yet. But that could come at a time where the breadth of earnings revisions has inflected in the wrong direction anyway. So that might be a double whammy relative to a story that has otherwise been a really positive story for the past year earnings. And then, of course, the debt ceiling. We could have a repeat of 2011. I think that was Janet Yellen's very strong warning. We know that it's a very well-played game in Washington on both sides of the aisle to sort of kick this can down to the 11th hour, but it's a risky proposition. And then Evergrande, not Evergrande specifically, but you have to think of the cockroach theory, when there's one. And it looks like Evergrande is contained. Most of the exposure is within China. But I just in general think more about debt and concentration. And I think there's more of a thread that weaves through things like Melvin Capital and its implosion because of GameStop and what happened with Archegos. And it's all about kind of leverage and concentrated positions. And I just wonder whether there's more there than what is perceived when you just look at all of those things in isolation.
Absolutely. And there's so much money sloshing around there because money is really cheap right now. I was looking at the junk bond market. Junk bond debt issuance is at an enormous pace right now. It's probably going to break records this year or come close to breaking records. But bond issuance in general, because there's so much available money and investors want to put capital to work. I want to dial it back a little bit to the basics of investing. If you have a 10-year or more time horizon and you're looking for returns, consistent returns, how should you position yourself today? Should you just be buying the markets, be diversified, and make sure that you're rebalancing frequently? What are you counseling folks who just say, look, I'm not an expert and I'm not an expert either, but what do you say to folks who are just like, I want to do this the right way without overthinking it?
So the first thing I would say is shame on anybody who answers that question with percentages in terms of asset classes, because I could actually have somebody come from the future into my office and actually tell me what 10-year return is going to be for equities and for fixed income broadly, but without telling me the kind of path along the way. Obviously, you can look at long-term rolling 10-year returns, but you know that the path that gets you there is often quite extreme. And I could be talking to two investors. So I could have this benefit of this person from the future telling me exactly what returns are going to be for both broad asset classes. And if investor A sitting across from me was 22 years old, just inherited $10 million, is very risk tolerant, doesn't need the money, doesn't need to earn income on the money, goes bungee jumping on the weekends, isn't going to look at their statement every month and freak out at the first 10% drop. That's investor A. Boy, now the spotlight's on me. Sorry about this. I wish I could do something about the sun
It's
here.
totally fine. You look good and sound good.
Um, Investor B is 75 years old, retired, has a nest egg, built that nest egg through lots of hard work, can't afford to lose any of it, and needs to live on the income associated with it. So, two investors, both with concern about the next 10 years. I have perfect clarity on what the ultimate returns are going to be, but what I would tell those investors would be two entirely different things. So, back to the tried and true disciplines. First of all, have a plan. And that plan is going to be different from one investor to another, depending on risk tolerance and time horizon. Hopefully, understanding that financial risk tolerance and emotional risk tolerance can sometimes be two entirely different things. And sometimes we only learn that through experience, and it's often bad experience. But once you have that plan, and it is established from a strategic asset allocation perspective tied to your personal situation, that's when the disciplines around rebalancing and diversification, even if you want to have a tactical overlay on top of that strategic allocation. And that's really where the willingness is to have maybe a core part of your portfolio in addition to, the explore portion. But I think it's that starting point of actually having a plan and making sure it's tied to who you are as an investor. Understand that in a low yield environment, this desperate search for yield that pushes people out the risk spectrum comes with a cost, given that risk. But that even if you are on some path toward a lower expected return for, say, the equity market, doesn't mean there aren't going to be opportunities during that process, either to pick up some appreciation or find yield in the equity market that's not so much available. Even a lot of strategies that can be done on the fixed income side, more active strategies to take advantage of short-term fluctuations in yields and inflation. And it's really it's not even as simple as that. The point is, it's complex. Because it involves a plan and asset allocation. We hope it's simple. We try to explain this stuff in simple terms, but the reality is there is no one, boy, here's the silver bullet, and this is the answer for everybody, because every investor is different.
Yeah, you and I would be out of a job if that were the case. Dale has that, basically asking that question, one of our attendees. He's managing his retirement, invested mostly in stocks because bonds have been anemic in terms of returns, and the pandemic hasn't seemed to change that. Will it at some point? What do you think about the debt?
Well, keep in mind that returns in the bond market. You've had some sort of periods here, even in the pandemic era, that have generated pretty significant total returns for bonds. When we were in that sort of pandemic move down to what became the low in the 10-year yield at 0.5 last year, obviously when yields are going down, prices are going up. For a good part of last year, the total return in bonds was handily outperforming the total return in equities. So it's not just the yield that is part of your return. There's the price component of it too. And sometimes when you're in that declining yield environment, we think of it in headline terms. Oh my gosh, what am I going to do with only 50 basis points of yield? If you've come from 200 basis points down to 50 basis points, you've made a heck of a lot on the price side. So you've generated that total return. So always understand that the returns in the bond market are not just about the yield. The yield is your return if you hold it fully through the duration, but there's that piece
Right.
of it that has to come into play. But you just have to be really careful about the stretch for yield. And one of the mistakes I find that investors make is if they're venturing into the equity market because of a desire for a pickup in yield, they will simply either just go into sectors that are historically higher yielding sectors, say utilities, without regard to the underlying fundamentals. Or they might just screen for dividend yield, rank it in descending order and say, I'm going to buy the stocks that have the lofty dividend yields. In a low yield environment, that's often a sign of weaker underlying fundamentals and the potential not only for the price depreciation, but also the potential for a trimming or cutting altogether of the dividends. So you still have to do your homework, especially if you're adding to that risk profile by moving out the spectrum for what at times might only be a pretty marginal pickup in yield.
Tony asked this question, one of our attendees: with all these headwind risks currently, how do you view climate as a risk? And how is Charles Schwab and your research team looking at climate and climate change?
So I think it obviously represents a risk for all of us as human beings and for the planet. From an investment perspective, it also offers opportunities as we really, I think, as a global community now start to approach this from a less political standpoint. That to me is, if there's one thing I've noticed in an otherwise pretty ugly political environment in the last couple of years, as we switched administrations from a party perspective and shifts in Congress, is there's less discussion about climate change from the perspective of right versus left, and more of it from the collective perspective of what do we do as individuals, as companies. And I think it also is part of the reason why ESG is not just a nice thing to talk about, not just a box to check, and not just something focused up by the investment community because there's demand from investors to invest in companies that have that focus, in the case of ESG, on the E specific to climate change. But what I find really kind of a new phenomenon is that the sort of demand for being aware of this, making adjustments to how you run your business, where your investments are headed, is not just investors that want to invest that way, but companies have to operate that way if they want to attract and retain employees, if they want to be good citizens within their community, and if they want their customers to do business with them. So it is so much more far reaching. I don't cover individual companies at all, so I can't say, all right, here are the 7 companies that are the biggest beneficiaries in terms of what's being done for climate change. But there are a lot of opportunities, even interestingly, within, say, a sector like energy, that is not only filled with fossil fuel companies, but even within many of those divisions that are really starting to think about innovations around climate change, not to mention a whole crop of startups. So, I think it's breeding opportunity as much as it is a problem of the human variety.
Absolutely. And a lot of investors might be surprised to see an oil company on an ESG list of stocks or in an ESG
Right.
ETF. But when you look at a company like a BP and a Shell and others, they're putting a lot of money into renewables because they know that's their future as well. But you'll even find the Facebooks and the Alphabets of the world on those ESG lists as well because of the S part, which is the societal part of it or the governance part of it, where they're not really necessarily environmental stewards per se, but it's is a broad term that's broadly misunderstood, but presents an opportunity, as you mentioned. We have a question here about the housing market. I know you follow the markets broadly in general, but one of our attendees asking, when you think the current housing market's going to cool down a little bit, if at all, or do you think we're going to be in a sustained period of high prices, whether if you're trying to invest in the housing market through one of the equities or the stocks that build homes or the REIT sector? How do you view the housing market right now, especially in the U.S., Lizanne?
We've already somewhat sporadically seen a bit of cooling in certain metrics and certain regions of the country. And I think it's really important, especially in this environment, to not think about housing monolithically, but think of it from a more localized perspective. So we know that the price appreciation has been epic, and on most national or even metropolitan area Case-Shiller type metrics, the price appreciation is well beyond what we saw during the housing bubble years. That said, even if you might want to apply the word bubble lowercase b to the sort of a magnitude of appreciation, maybe that's appropriate, but the underlying leverage and the trillions of dollars of derivatives infecting the global financial system that defined the implosion that happened in 2007 and 2008, that just doesn't exist in this environment. But we have started to see a waning in demand simply because prices have gone up. There are several surveys that are done, including embedded in some of the consumer sentiment and consumer confidence surveys that measure whether you think it's a good time to buy. And buy a house is one of them, buy a car is one of them. And those buying intention metrics within some of these surveys have never been as low as they are right now. So I think much as whoever said it first about commodities, the cure for high commodity prices is high commodity prices, and that it just gets to a point where it starts to crimp demand. That's part of the reason why we're seeing the rental market pick back up again, and you're starting to see that embedded in the inflation numbers, particularly CPI, which has 40% of core CPI is the rental owner's equivalent rent component, because there are an increasing number of people that have simply been priced out of the market. So I would expect that in areas where that price increase was sufficient enough to start to dent demand, I would expect more of a rolling over than a crash, a la 06 to 08, because of some of those aforementioned very important differences. And we are also starting to see some supply kick in as well. And I actually think the investment, when you think about real estate investment, investment in both single family and multifamily is a pretty attractive part of the economy and market right now because of that need to add to inventory. So I think it's going to be a more of a slow rolling over on the price side, because we just see waning demand due to affordability. And then that would be exacerbated, and I think we would speed up that rolling over in prices if we have some sort of situation that causes longer term interest rates to move up at a faster trajectory, because you already have the hit to housing affordability from higher home prices. You have the hit from a real personal income standpoint, because you're subtracting a larger inflation number out of that personal income. If you add that triple hit to much higher mortgage rates, then you really lose the housing affordability side of the argument. And that could be a bigger problem for home prices if we were to see that bigger move up in yields.
Yeah, 30-year is not even 3% right now, a 30-year fixed mortgage. So money is cheap if you want to borrow and you have the means to make a down payment, and if you can find something available, because community to community across the country, very hard to find housing supply right now. I want to ask you just a broader, more of a metaphysical question about the stock market itself. It's gotten so big, especially in the last year and a half, but it's just been growing as more and more index investors and more passive investors have come into the market. We did have about 18 to 20 million new investors and traders join the market in the last year and a half, but it's a very big stock market with mega cap companies in it. Is it too big to really fail? And I don't mean crash, because we've seen that it can crash, but is it so big, is there so much money passively invested in it that even when we get these 5%, 10% dips, the money, it just regains its footing because there's just so much money in it that won't allow it to go down. And it seems like central banks don't want that to happen either. What's your take on that?
Well, it may be that central banks don't want it to happen. None of us, I suppose, if we're biased long investors and not in short investors, want that to happen. I think the potential miscalculation is that the Fed won't let it happen. That either via the liquidity they continue to pump into the system, or more directly their willingness or desire to kind of step in to constrain volatility. That's where I think we may be kind of pushing the envelope a little bit. I will never forget, I went to, Jerome Powell spoke at the Economic Club of New York in December of 2018. And it was, a live in-person lunch in New York, about 1,500 people. And it was well publicized. I don't know if were you there, Caleb? That's something you covered
I
at
tuned
the
into
time?
it for sure.
Yeah,
I was
so
tuning into it.
some may remember that some of Powell's comments in September of that year with regard to tightening policy was sort of the primary reason why the market went into a pretty significant tailspin. We just managed to have a decline just shy of bear market territory. I think the S&P was down 19.8%. But at that lunch, Powell did a lot of backpedaling. He went very much on script. He was reading from his notes. He had been a bit more off script in September, and his words were probably maybe moved around a little bit more than he would have liked. So he was on script, and most of the attention, most of the headlines that came out of that lunch was about, okay, Powell backpedaled, and that was seen as a stabilizing influence on the stock market. But one of the things that he said during that lunch, it was one of the times where he lifted his head from his notes and looked at the audience. And there was something about the body language. I don't remember his exact words, but effectively he said, investors or market watchers or Fed watchers, I don't remember what the preamble was, need to understand that there's an important difference between financial market volatility and financial system stability. That the Fed is focused on the latter. They're not in there to prevent every variety of the former. If financial market volatility threatens the financial system stability, that's a different thing. But in isolation, simple market volatility does not suggest the Fed's going to have to step in. Now, when you're in more tenuous economic situation, then you don't want to exacerbate a problem by causing a rout in the stock market. But in and of itself, if we go through a period of volatility, especially if it's driven by rampant speculation and it sits outside any systemic problem in the financial system or in the economy, I don't think they view their sort of unspoken third mandate as being, we're not going to let the market have even a 10% correction. So I think that narrative is going to be tested. Maybe not imminently, but I think it will be tested.
Well, we're going to have to watch for it tomorrow. On the way out, Liz Ann, and we appreciate your guidance and your counsel and all the information you've been sharing with us. Just words for investors right now as you look towards the next year, final quarter here, but really going out to the next year, counseling just individual retail investors who are, again, not trying to be experts here, just trying to play it safe. What are your words of advice for them?
So I just wrote a report that I published yesterday that was bigger picture, look back on my 35 years in the business. And I did it in the context of quotes from some of the investment greats, either those for whom I've worked or some of the famous investing books, many of which sit on my shelf, about just some of the tried and true lessons, especially when you get into an environment where either valuations are stretched or speculative activity is most significant. And one of the overarching themes, and it's tied to something I always say, which is it's not what you know that matters, meaning about the future, when's the next move up or down in the market. It's what you do that matters. And I think that investors often think the key to success is knowing what's going to happen and then positioning accordingly in advance. And that's just gambling on moments in time. One of the common questions I get from the financial media, especially if it's one of those, markets in turmoil kind of special, will say, what are you telling investors to do now? Get in or get out? And I have such a love-hate relationship with that question. I hate it because it's a ridiculous question, but I love it because I get to explain why I think it's a ridiculous question. Neither get in nor get out is an investing strategy, period. That's just gambling on moments in time. And investing should always be a disciplined process over time. Even if it's not headline grabbing, even if it's not going to capture the most attention on social media or on the Wall Street Bets platform on Reddit, it's those tried and true disciplines, and those important lessons that come from the greats that are not about get in or get out. It is the discipline around understanding that you need to have that approach toward diversification and rebalancing, and buy when there's blood in the street. I want to buy when people are selling, and vice versa. And we just have to regularly remind ourselves of that, especially when you get into sort of a hyped up kind of market where there is lots of sort of FOMO, and there are and have been lots of shiny new objects.
You are the voice of reason, as always, and we so appreciate you joining us to help us take us home on our Your Money, Your Health Summit. Liz Ann Saunders, folks, you can follow her research. You can follow her on the social media platforms. I always learn when I listen to you, when I read your stuff, and we're so grateful to you for joining us at our summit today. Thank you, Liz Ann.
I always enjoy our conversations, and now literally and figuratively, the spotlight or the sunlight is off of me. So I'm glad you had a great summit, and was happy to be here.
Thank you so much. Well, folks, what a fascinating afternoon of conversation and insights. I learned so much. I have notebooks full of stuff I was writing down feverishly. I want to bring in my co-panelists, Amy Marin, the editor-in-chief of Verywell Mind, and Dr. Jessica Shepard, the chief medical officer for Verywell.com. Guys, I don't know about you, but I was scribbling things left and right. What fascinating panels, and I'm so grateful to our guests. Jess, let me start with you. Of all the things you maybe wrote down today or heard today, what is the one thing you're going to take with you into your practice as we leave here?
Sorry about that. One thing that I think that carried through all the different panels was the optimism when we look at overall health, whether that's emotional health, financial health, physical health, is that we finally have reached a point in this pandemic where we actually can start to look forward to the future. But taking the steps and tools and tips that we learned today is how to actually implement that, because we are at a different time and a different stage in healthcare. And I think that we have to take advantage of the tools that we've been given, but also what we've learned through this time in order to continue to impact our patients when it comes to their health, but also giving them the tools to thrive.
Yeah. And Amy, what key learning or idea resonated with you that you'll take into your practice, but also as the editor-in-chief of Verywell Mind? What stood out?
So many things, but I guess if I had to pick one, it would just be to focus on what you can control and to create a plan. That we don't all have the answers right now, but knowing that we can create a plan for ourselves and be prepared for whatever life throws our way next is quite reassuring. So I plan to work with people and in my own life on just making sure that I have plans written down and ready to go, both for financial health, mental health, and all areas of life.
Yeah, absolutely. I learned that as well. And you saw that through line through every conversation. Have a plan, have those conversations, right? None of this should come as a surprise to any of us, but it's really hard to do that. And it's very simple, but the simple things are so hard to do. Special thanks to both of you and to the panelists you helped bring into this conversation. So valuable, so important. And folks, all those conversations, everything we've done here today, we've recorded it. We're going to put it back up on our site on investopedia.com/conference. We're going to put it out on social media. Lots of sharing of this information. But I also want to thank, first of all, both of you for hosting great panels, but also our teams here at Verywell and Investopedia for helping us put this together, especially Sienna Wren, Anna Atkinson, Alex Kerr, Walden Sue, Clay Halton, Julia Kagan, Dylan Zerwell, John Roberts, Rachel Berman, Sarah Michaels, and Chris Cannon, among others. It takes a village to do these things, and we've had a great time doing it. So I really want to thank our teams for helping make this happen. And a special thanks to all of you attendees out there. You really made this special. Really smart questions, both ahead of the summit and throughout the summit. So many of you joined us, and we're so grateful to have you with us. And I learned that we're going to have to do more of these because the engagement was so high and the learning was so good that I can't wait for the next one. So stay tuned for that. Again, all of these sessions will be available on Investopedia.com, and we'll share them through our social platforms. But as always, the content is there on verywell.com, verywellmind, and Investopedia.com for any answers you have to your finance or health questions. And we so appreciate you joining us, and we will see you at the next summit. Thanks so much.